What's going on, everyone? It's Justin here with another video. Appreciate you guys tuning in. What a day we had in the market today. So for most of the day, the market was actually slightly down until the afternoon, and I think it was right about before the Fed announced that it was going to keep rates steady. We saw a little uptick in the market, and the market flipped from red to green. And then Powell went and gave his press conference, and the market, ripped after that before fading in the afternoon. I thought the action was pretty interesting because I listened to the press conference with Powell, and he didn't say anything, in my opinion, that was too surprising or wasn't what people had expected. There's a few nuggets from the press conference that I thought were interesting. For one, he dismissed the idea of stagflation, which is this idea that the economy's going to really stall out, that employment's going to increase while at the same time dealing with persistent inflation. He just came out and said, that's not something we're even remotely worried about right now, given where inflation's at and how strong the economy still is. The other important thing that he mentioned on the call, or at least it was perceived this way, was that the Fed didn't have any intention to hike rates anytime soon, and it basically took a rate hike off the table, and the market seemed to like that news. But again, I thought that was interesting because that was not something that most people had expected. I don't think most people were thinking the Fed, a rate hike would have been, disastrous for the market if they either did that today or talked about doing that. I think what most people were tuning into this press conference for was to see if the Fed was talking or had any inclination to cut rates. And we really didn't get any of that either. It was more the Fed is going to take a wait and see approach and, let the data come in, and they still want to see more evidence of inflation coming down. But nonetheless, the initial reaction to both the policy decision and Powell's speech press conference was a strong rally. I think at one point, the Qs were up 1.4, 1.5% on the day. And then towards the last hour, the final maybe 30, 45 minutes of the day, all those gains just went down the toilet. They were erased, and we ended the day slightly down. And I think the reason that happened is because across the board, we ran up into resistance. So I don't think it's any surprise for people to know that the uptrend that we had been in for several months, at least in the short term, has likely come to an end. And now we're in a short term, possibly intermediate term downtrend. And you can see that clearly on SPY. And so what happened today was we've had this rally the past few days. And today we came up and retested that declining 20-day moving average. Sometimes I'll use the 21-day EMA. Doesn't really matter in this case because, SPY and Q and a lot of important index ETFs and thematic ETFs, sector ETFs are below this key moving average here. So you can see we came up, retested it. We're unable to close above it. And this is really where the selling pressure came in on the SPY. And at this point, I think a lot of people are wondering, where do we go from here? And I don't have a crystal ball, so unfortunately I can't tell you exactly. But one thing I would be watching at this point, since we are below the 20, we're also below the declining 50-day moving average, is we got to pull up and see where this rising 200-day moving average is at right now. And the 200-day moving average is about a little over 6.6% from where we're at currently. Now, that's not to say we're going to get there right away, or this would go in a straight line down. So we might not fall all the way down here because this is still rising. So this will be another level that I'm watching up here, which is about 478, 480, which is, we have an area of support here. And if you zoom out, I also think this coincides with the prior cycle high. So you can see why this is an important level here. We have the prior cycle highs up here, and then we have this shelf where we traded at for a few weeks up here to act as potential support. And then you have that rising 200-day moving average. And by the time we come down here and potentially test this area, the 200-day moving average could be up there to act as support. And at that point, we could resume the uptrend that we had been in for quite some time now. I think it's a very similar story when we look at the Qs. Same situation here. So what do we have? We had a rally up. We didn't quite get to the 20-day on the Qs, which had been a little bit weaker than the SPY as of late because of the heavy concentration of tech stocks in the Qs. But nonetheless, we came up and were unable to reclaim that 20-day moving average. So to me, this is still a market that's guilty until proven innocent. Until we can reclaim some of these key moving averages, I would expect some more downside, or at the very least chop for both the SPY and the Qs. Same thing with the Dow Jones Industrial Average. Came up here and tried to reclaim that declining 200-day moving average, 20-day moving average, and we got rejected. This still closed the day up, but nonetheless, it's a rejection, and it's starting to look like a bear flag here, at least in the short term. The New York Stock Exchange Composite Index, same situation, came up, tried to reclaim it, got rejected. In this case, we have some support that's not too far off, so we could pull back down into this level here and maybe chop around and build a base. And this also coincides with some higher time frame support here. You can see a little bit more clearly on the weekly. This goes back to the prior cycle highs. So we could just chop around here, and this might need a little bit more time to get going and reset before ultimately heading higher. But the good positive about the New York Stock Exchange Composite Index is that we're still above this rising 20-week moving average. So there is some support up here on that. I'm going to look at RSP. This is the equal weight S&P 500 ETF. So here we had a false breakout. Broke out above our prior all-time highs, but we couldn't stick the landing. And then we fell back below that 20-day moving average today, rallied up into it, got rejected. Same thing with the equal weight Qs. Although we didn't quite get there, we rallied, and that rally was faded pretty hard. The tech sector ETF, XLK, same situation here. We're stuck below this declining 20-day moving average, and that's created some problems. SMH, the semiconductor ETF, this has been one of the strongest sectors in the entire market, rallied up. It got close to the 20-day moving average, didn't quite get there, but nonetheless, a rejection and a fade. So that is a bit of a concern. Even financials, while financials closed the day flat, 0.00%, we were unable to get back above that 20-day moving average, and you can see how it's acted as resistance on the way down. We got back above it briefly, but then once we fell back below it, it's just been pushing financial stocks lower and lower. So that's been a problem and something to watch. Industrials, again, since breaking this uptrend that we were in here since late October of last year, we've been stuck below that 20-day moving average, and now we're having some higher volume selling pressure coming in here, and we came up, tried to reclaim the 20-day today, got rejected. Even healthcare is having some issues with its 20-day moving average. This actually closed the day up. It's a little bit more of a defensive area of the market, and so we closed the day up about 0.2%, and actually closed slightly above this 20-day moving average, but I don't know if it's enough to really reclaim it and get moving here. It's just got above it barely today. One area of the market that is standing out and that hasn't had any trouble getting back above its 20-day moving average and holding it is utilities. You can see this clearly here. We're looking at XLU, and since breaking this downtrend here, this has been one of the strongest areas in the entire market. And that's great if you own utility stocks, but this is not typically what you want to see in a bear market, in a bull market, in a risk-on environment. Utilities are widely seen as one of the more defensive areas in the entire market, and right now they're outperforming basically everything. As of late, you can see we are up or headed for our third green week in a row, and actually, year to date, utilities are now outperforming SPY. I think XLU is up about 6%, and the S&P 500 or SPY is up about 5.5%. And so we just crossed above SPY in the past few days. So this is a development to keep a very close eye on. You also want to keep a close eye on bonds. I think a lot of people, traditionally view treasuries as a safe haven asset. They haven't been acting that way lately, and that's because inflation has been so high, and the yields on bonds just haven't been very attractive. But an interesting development is that over the past few days, or past few weeks, really, bonds have found support this prior area of support over here. We didn't come back down and test the lows quite yet, but we stopped at this area where there's a lot of price memory, and so far this level is holding. We are still in a downtrend by basically all measures. You can see every moving average I throw on here. We're below all of those, but what's interesting to me is that this has stopped falling, and even today this closed up 0.4%. So what's interesting here is a new development that could be happening in the market place right now is that maybe the concern about inflation is mispriced, and maybe there's another concern about the market that not a lot of investors or traders are taking seriously enough, and that's a potential slowdown in the economy. Because if inflation was the major concern, I don't think we'd be seeing this outperformance of bonds relative to stocks, which is what we've been seeing the past few days. So it's definitely a development to keep an eye on. Another chart you're going to want to watch really closely is how XLP, so that's consumer staples, perform relative to SPY. You can see on this chart that I have the 21-day EMA down here, and what you're going to want to look out for is if XLPs, if we get a trend change in this ratio and consumer staples start to really outperform the market. And we had that happen in late 2021, and that happened right around until the stock market bottomed in late 2022. So during that time period, staples were doing better than the market, and that's because staples sell things that people need, that people can't live without. Think toothpaste, think milk, butter, laundry detergent, those sorts of things. And when there's really strong demand for those stocks over your average stock or your growth stocks, that can sometimes indicate trouble ahead. And so this is a ratio I'm keeping a very close eye on. I just use the 21-day. You can use whatever, but what you don't want to see is this, start heading lower or start heading higher. You don't want to see, evidence of higher highs and higher lows on this ratio chart, because that could mean that the market is running into trouble. Another way to think about it or look at it is to compare XLP with XLY. So this is consumer staples versus consumer discretionary stocks. Discretionary stocks sell stuff that people want rather than need. And you can see that XLP really outperformed XLY during this period. So this was coming out of the COVID crash. We had that monster rally that lasted until late 2021. And then at that point, this ratio bottomed and flipped and went in the opposite direction and started heading higher, meaning consumer staples outperformed XLY. And during that time, that was obviously a really tough period for most stocks. The market, really got its butt kicked in 2022. But then in late 2022, this ratio topped out again and started falling. And basically since then, it's been a good time to own stocks. But now what's happening here is this ratio is starting to bottom out a little bit. It hasn't broke out to the upside yet, but this is something I would definitely want to keep a very, very close eye on, because if this starts moving higher, that means that people or investors are favoring stocks that provide things people need over stocks that provide things people want. And typically that can indicate some problems with the market. The other major thing you're going to want to keep an eye on is the dollar. So unlike most charts we've looked at today, most, at least at the index level and the sector ETFs we've looked at today, so most of those were below a declining 21-day or 20-day EMA. In this case, you can see that the dollar is, it's still trading sideways and essentially range bound. But we have broken this downtrend that we've been in since October of 2022, and starting to look constructive. I think that if this was a growth stock, a lot of people would be all over this, because it's starting to look pretty bullish here. The dynamics of the U.S. dollar index doesn't always work exactly like a growth stock or just any stock in general. It's a little slower moving, and there's a lot of other macro factors at play. But nonetheless, we want to keep a very close eye on this chart and monitor if we break above this level here. So about 107 is the key level that I would be watching, because if we take off these late 2023 highs, then I think the next logical area to watch would be these prior highs up here, and that would be a really big move. That would be from about 106, 105 all the way up to 115, which is a huge move for the US dollar index. So definitely something to keep a very close eye on. As far as areas of the market that have my attention, that I think are interesting on the long side right now, I think uranium is an area of the market that I would keep a very close eye on. So yesterday, Cameco came out and delivered earnings, and I didn't dive super deep into their earnings, but it triggered a sell-off that also coincided with just a broader risk-off environment yesterday, and a lot of uranium stocks, including Cameco, got hit hard, sold off. Some of them fell about 7-9%. So some pretty big hits. But today, we saw a strong bounce back in uranium stocks across the board, really. And a big reason for this is that the Biden administration announced that they're going to, I think, just ban or limit the amount of uranium supply that we get from Russia, and so that had a positive impact on uranium stocks because it could potentially trigger a supply crunch of sorts, which for commodity stocks like uranium could be really, really bullish. And just on a higher time frame basis, when we look at this on the weekly, this still looks really, really constructive. You can see we're still above. We're still starting to break out of the space here. We're still above this rising 21-week EMA. We're just kind of chopping around here, and so I think this is still set up on a higher time frame basis. It might not, get the breakout that bulls are hoping for with the indexes under so much pressure. But all things considered, I think this is looking like one of the stronger areas of the market. It's also a small, pretty niche environment, which I found can kind of do its own thing. If you add up the market caps of all the uranium stocks that trade on U.S. exchanges, it's really, really small. So this is a tiny market that can kind of do its own thing, regardless of macro conditions. So definitely an area to keep a close eye on. I also really like the relative strength, longer term relative strength potential of uranium stocks when we compare them to the S&P 500. So you can see. We're looking at URA versus SPY here, and you can see that there's basically a decade-long period where uranium stocks were just on the do not touch list. They were some of the worst performers in the entire market. This bottomed in COVID, like a lot of energy stocks did, and since then this has been trending in the right direction. Had a really strong rally off those lows, and then we've just been trading sideways in this range on a relative basis for about 2 years. So this still looks constructive to me. This still looks like the early stages of a new uptrend for uranium stocks against or relative to the broader market. It hasn't broken out to the upside yet, but I think once that does happen, uranium stocks are going to be really, really strong performers, major outperformers relative to the broader market. So that hasn't happened yet, but it gets me excited about the long-term potential of these stocks. So definitely an area to keep an eye on. But as far as other areas of the market that I'm looking at, I have some stocks, a lot of individual stocks that I think are holding up well and could be decent buys here. But my concern as someone who is primarily a swing trader is that it's just going to be probably very hard to make money on the long side in the near term. Not saying that all these stocks that are holding up and showing relative strength right now are going to get destroyed or crash or anything like that. But it's just not the best environment for a trend follower, at least on the long side for a lot of these names. I think you're going to need a little more support, and you're going to need more tailwinds and help from the indexes for it to be a really good environment to swing trade. So that's kind of how I'm thinking about the market right now. But I hope you found this video informative, and until next time.